I go into a lot of businesses where the owner glances at their P&L, sees what they spent on payroll, what they spent on materials, and the number sitting at the very bottom, and moves on. There's actually a lot more sitting in that one document than a quick glance ever tells you. I'm Billy Malone, and this is Beyond the Estimate. So today, I want to walk through an actual P&L, top to bottom, one real line at a time, using a general contractor we'll call Gary as the example. Gary runs a company doing about $5.8 million a year. By the end of this, you'll know exactly what each number on your own P&L is actually telling you, not just what it says. Before we get into this, let's make sure we're speaking the same language. P&L stands for profit and loss. You'll also hear it called an income statement. It's the same document, just with a different name. A lot of my clients run QuickBooks, so that's what we'll use for the actual examples here, though plenty of other software works fine too. It's worth knowing going in. QuickBooks doesn't always use the terms you'd expect. It labels revenue as income, it labels overhead as expenses, and at the very bottom it calls net profit net income. None of that's wrong exactly, it's just confusing since in plain English those words usually mean something a little different than what they mean sitting inside a P&L. So as we go, I'll use both sets of terms together so you know exactly what you're looking at no matter what your own software happens to call it. One more thing before we get into it. I kept this P&L relatively simple so it's easy to follow along. Yours might have more accounts, more subcategories, more going on than what you'll see here. The concepts are exactly the same either way, so don't worry if your own P&L looks a little more crowded than Gary's. Let's start at the very top of the P&L because that's where everyone starts and it's usually the number people feel best about. On Gary's P&L, you'll notice this section is actually labeled income, not revenue, going back to that QuickBooks wording we just talked about. Same thing, different word. In a basic setup like Gary's, revenue, or income, is generally what you build out during that period. You'll also notice near the top it says accrual basis. In a setup like this, that generally means Gary's books count revenue around the time he creates the invoice and expenses around the time he enters the bill, not necessarily when the money actually moves. Some construction companies track revenue differently based on job progress instead of billings, but this is the version most small contractors are actually looking at day to day. Many businesses run their books this way, though some smaller ones run on a cash basis instead, only counting things once money actually moves. It's worth knowing which one you're looking at, since it changes how these numbers line up with what's actually sitting in your bank account. And that's exactly the thing worth knowing about revenue specifically. It reflects what you've invoiced, not necessarily what's landed in your account yet. Those are two different things, and the gap between them is exactly what got a contractor I worked with into trouble. He billed a client $85,000, and that number sat on his P&L looking like real revenue for months before he realized it had never actually been collected. Gary's revenue for the year, $5,800,000. That's our starting point, and everything else on the P&L is really just answering one question. Out of that $5.8 million, how much of it actually turns into profit by the time everything's accounted for? Real quick, if this is useful to you, hit subscribe. I put these out every week. Now we get to cost of goods sold, and this is where things start to matter a lot more than people realize. QuickBooks actually gets this label right, so no confusing wording change here. Cost of goods sold means exactly what it sounds like. It's everything a job actually costs you to do. Here's a useful shortcut, not a hard rule. If a cost rises and falls with the jobs you're actually doing, it generally belongs here in cost of goods sold. Materials, subcontractors, the labor actually swinging a hammer on site, equipment rental and fuel for that equipment, permits, dumpster rental, small tools, temporary site utilities. All of it exists because of a specific job, not because the business exists in general. On Gary's P&L, you can see his labor broken out in real detail. Wages, payroll taxes, workers' comp, and benefits, all sitting right here in cost of goods sold where it belongs. Now, here's something worth knowing if your own P&L doesn't look anything like this. A lot of contractors' books don't actually separate direct labor out this way at all. It just gets lumped in with everything else, often because that's simply how QuickBooks sets things up by default unless somebody goes in and redirects it. That's not something we're getting into deeply today. That's really its own conversation about how your chart of accounts gets built. But if your labor isn't broken out like this, it's usually not because you did anything wrong. It's because nobody ever went in and set it up to be tracked that way. Getting help setting that up correctly is worth it, and it's something I do with clients regularly. Add up everything in this section, and Gary's total cost of goods sold for the year comes to $4,815,720. Put another way, out of every dollar Gary brings in, about 83 cents goes straight to covering what the jobs themselves cost before overhead or profit ever enter the picture. That's a useful number to know for your own business too, since it tells you right away how much room is actually left over once the jobs are paid for. Right below cost of goods sold, you'll see gross profit. This is one of the few spots where QuickBooks actually uses the term you'd expect, no confusing wording here. Gross profit is simply revenue minus cost of goods sold. For Gary, that comes out to $984,280. On its own, that dollar figure doesn't tell you much, since a bigger company will naturally have a bigger number just from doing more volume. What actually matters is turning that into a percentage called gross margin by dividing gross profit by revenue. For Gary, that works out to 17%. That 17% is telling you something specific. For every dollar of work Gary does, 17 cents is left over after covering what that job actually cost him before he's paid a single overhead bill. This is genuinely one of the most useful numbers on the entire P&L because it tells you how healthy your actual jobs are, separate from how well you're running the business day to day. A contractor with a strong gross margin but a struggling bottom line usually has an overhead problem. A contractor with a weak gross margin has something going on underneath it. Pricing, estimating, job execution, purchasing, take your pick, but it's worth digging into. In the general contractors I typically work with, I usually see healthy gross margins land somewhere between 15 and 30%, though that varies a good bit by market and how a company classifies its cost. Gary's 17% puts him on the lower end of healthy, not in trouble, but not a lot of room to spare either. Either way, this is the number worth knowing cold, not just glancing at once a year. So below gross profit, you'll see a section labeled expenses. This is the QuickBooks wording mismatch we talked about at the start. This section is what most people mean when they say overhead. Same thing, different word again. If cost of goods sold is what a job cost you, overhead is what it costs to keep the lights on and the doors open, whether you're working on a single job or not. I like to tell clients it's simpler than it sounds. Overhead is paying the bills. Rent, utilities, insurance, the people who run the office instead of the job site. On Gary's P&L, you can see real examples of this. Office rent, general liability and auto insurance, marketing, software, and his admin staff's wages, taxes, and benefits. Same detailed breakdown we saw on the labor side of cost of goods sold. You'll also notice Gary pays himself a real salary sitting right here in this section. Since Gary's company is an S-Corp and he actively works in the business, the IRS generally requires him to receive reasonable compensation. If you're a sole proprietor instead, your own draws won't show up as a P&L expense at all. That's just how the accounting works for that structure. Either way, it's worth thinking about what it would actually cost to replace the work you personally do, even if your own books don't show it as an expense. So add up everything in this section, and Gary's total overhead for the year comes to $580,000. Now here's the test worth remembering to tell the difference between these two categories going forward. Cost of goods sold rises and falls with the jobs you're doing. Overhead doesn't. It's there whether you're working or not. That one distinction is really the whole lesson buried inside this entire video. Everything else is just showing you where it shows up on the actual document. Subtract expenses from gross profit and you land on a number labeled net operating income. $984,000 $280 minus $580,000, which comes to $404,280. Notice this one isn't just called net income yet. It says net operating income specifically, and that word operating is doing real work. It means this number reflects how the actual business operated all year, the jobs and overhead, nothing else. Below that, you'll see two more sections, other income and other expenses. These generally capture activity outside the core day-to-day operations of the business. For Gary, other income is a small amount of interest in his bank account earned, $8,450, something that could easily show up again next year. Other expenses here is a $45,000 consulting project Gary brought in outside help for, a real cost, but one he and his accountant chose to break out separately here so it wouldn't get mixed in with his normal, ongoing overhead and make a typical year look more expensive than it actually is. Net those two against each other, and you get net other income, a negative $36,550. Apply that loss to net operating income, and you arrive at net income, $367,730. Worth knowing, this is accounting profit, not necessarily cash sitting in the bank, since things like loan principal or equipment purchases don't show up here the way you'd expect. So that's the whole P&L, top to bottom. We covered a lot today. Gross margin, overhead, accrual versus cash, one-time income and expenses, and I did that on purpose so you actually know what you're looking at instead of just recognizing the words. I didn't go deep into any one of these, and that was deliberate too. Gross margin versus net margin alone is worth its own full conversation, and I'll get into that in a future video, along with a few other things we touched on today but didn't fully unpack. If you've got questions about anything we covered, drop them in the comments. I'll do my best to answer them. I started doing this work because I spent years watching good, hardworking owners get blindsided by exactly this kind of thing, not because they were bad at running their business, but because nobody ever explained it to them. That's why I started Stravalon. If you want someone to actually sit down and look at your own numbers, there's a link below. Thanks for watching, and I'll see you in the next one.